Let's talk about a brand we all know, Wendy's. But we're not just going to talk about burgers and fries. We're going to look at it from a totally different angle. The big question we're digging into today is this. Is Wendy's a hidden gem for investors, or is it a financial time bomb just waiting to go off? I mean, you know the deal, right? The square patty that's fresh, never frozen, that classic Frosty. These things are basically fast food royalty. Wendy's has built its whole identity on being just a little bit different, a little bit better quality. But here's the thing. Just because you love the food doesn't mean the company is a great investment. Behind that familiar drive-through window, there's a business facing some pretty serious headwinds. So the real question is, should you actually put your money where your mouth is? To figure this all out, we're not just going to glance at the stock price. No, we're going to break it down using the playbook of the master himself, Warren Buffett. We're looking for a great business with a strong defense, smart management, and of course, a fair price. So let's put on our Buffett glasses and see what we can find. Okay, first up in the Buffett checklist is what he famously calls the economic moat. The idea is simple. Think of the company as a castle. What we need to figure out is how wide and deep its protective moat is. You know, the thing that keeps all the competitors at bay. So an economic moat is just a fancy term for a lasting competitive advantage. It could be a super powerful brand, a secret sauce that keeps costs low, or some killer technology. It's the magic ingredient that lets a company stay profitable for a really, really long time. And right away, we kind of hit a snag. See, Wendy's has a moat, but most analysts would call it narrow. It's almost entirely built on that freshness brand identity. And yeah, it's a top 3 player, which is great, but it just doesn't have the colossal scale of a titan like McDonald's. And we've seen it get pushed around in big fights, like the breakfast wars. And this chart, wow, this really puts that scale problem into perspective. Just look at the average sales for a single restaurant. McDonald's is raking in over $4 million a pop. Wendy's, it's sitting at about half that. Now, they're beating Burger King, sure, but that gap between them and the Golden Arches is absolutely massive. That's a moat you can measure in millions of dollars. Okay, so if your moat's a little on the narrow side, what do? Well, if you're smart, you start a major renovation project. So let's take a look at how Wendy's management is trying to beef up its defenses with a new strategy they're calling Project Fresh. And what I like here is how clear and simple this plan is. It's really got 3 pillars. First, the cleanup. They're getting rid of 300 to 350 stores that just aren't pulling their weight. Second, a marketing reboot. They're bringing in the pros to get their brand message sharp again. And third, and this is the cool part, a potential moat expander. They're putting AI in the drive-thru. And that AI, it's not just a gimmick. The early numbers are pretty incredible. It's slashing drive-thru times by an average of 22 seconds. Plus, it's getting orders right 99% of the time. In the world of fast food, speed and accuracy are the whole game. This could be a game changer for cutting costs and keeping customers happy. All right, that turnaround plan sounds pretty good, right? But a true Buffett-style analysis means you have to inspect the castle's foundations. And when we look at Wendy's balance sheet, we find a huge, flashing red light. We're talking about a mountain of debt. Now, at first glance, this is what might suck you in. You see that number, a nearly 7% dividend yield. That means the company pays you almost 7% of your investment back each year just for owning the stock. In this market, that is an incredibly tempting number. But then you see this, and yeah, that is not a typo. A debt-to-equity ratio of over 2,300%. The company is funded by a gigantic pile of debt compared to its actual value. Honestly, this is the kind of number that would make a cautious investor like Warren Buffett just turn and run for the hills. And here's the kicker for that juicy dividend. To pay it, Wendy's is using almost every single dollar of profit it makes. The payout ratio is nearly 100%. That means there is zero room for error. If the economy takes a downturn and profits dip even a little, that dividend could be gone in a flash. Okay, so let's recap. We've got a narrow moat, a scary amount of debt, but a solid turnaround plan. It's a complicated picture, right? But there's one more character in this story that completely changes the dynamic. A very powerful, very involved billionaire investor. That billionaire is Nelson Peltz.
His firm owns a massive 16% stake in Wendy's, and he's not just sitting back and collecting checks. He's on the board, he's known for shaking things up, and this is the big one, he's hinted that he might just buy the entire company outright.
And this right here is the whole ballgame for a lot of investors. Pelta's presence acts like a potential safety net under the stock price. The theory is that if the stock falls too far, he'll just see it as a bargain, swoop in, and buy the company, which would almost certainly mean a nice payday for the current shareholders. So, with that billionaire safety net in the background, management is full steam ahead on their growth plan. They're pushing into new countries, they're trying to get more people using their app, they're focusing on value deals, and of course, they're rolling out more of that automation tech. This is the roadmap they're betting on. So, we have all the pieces on the board. The narrow moat, the ambitious plan, that terrifying debt, and the billionaire wildcard. It's time to put it all together and figure out what the final verdict is. And what better way to frame our conclusion than with Buffett's most famous quote? It's such a simple but powerful idea. The price tag on a stock is one thing, but what the business is actually worth in the long run, that can be something else entirely. So the bottom line seems to be this. Wendy's is what sports fans would call a rebuilding year stock. This isn't a safe blue chip company right now. It's a classic special situation. It's a high-risk bet, for sure, but if you believe in that turnaround plan and you trust that Nelson Peltz provides a safety net, it could also be a very high-reward one. So that's what it all comes down to, really. It's a bet on a comeback story, with a billionaire looking over everyone's shoulder. You're weighing a shaky foundation against a really interesting blueprint for the future. It's a high-stakes gamble. So the question for you is, would you take that bet?